Hi, this is Dan in the green trading room, and we're just going to analyze this trade that we're in right now that we recommended yesterday, and it was a bullish option trade on Tesla. And I got a couple of emails because they're like, wow, Tesla has a lot of bad news, so are you sure you guys want to be doing bullish trades? And my answer is absolutely. That's our expertise, but we do them with a calculated methodology, not blindly. So let's jump in and you can see why we did this trade and how we're managing it. So we sell high volatility when, I like to call it when the storm is past. You know, when volatility rises, fear rises, the price of the options goes through the roof. And as option sellers, that's more money in our pocket when we sell those calls and puts around the patterns for our weekly and monthly income. Tesla, I mean, you didn't have to go far to find bad news. Look at this, JP Morgan downgrading it to $1.98. Tesla's in free fall. The SEC is going after them. There was another article in the Wall Street Journal this morning saying their vendors are now complaining they may not get paid. Anyway, just suffice it. It's in the middle of a, gotta respect. All right, that was just a comment from Neil here. But IV percentile ranking, what does that mean? It looks at the volatility of Tesla for these puts that we sold just 5 days to expiration, and it's looking at that volatility number and it's ranking it from 0 to 100 over the past year, and it is 99% highest volatility right now than it is over the past year. So that's all I need to know, that it's high. Everything we do starts with a chart. Here's Tesla daily chart, and this was the close yesterday. You know, I had an ugly breakout failure out here. It was bearish. I mean, you could have done bearish option and stock trades on this. But then when the news is just full of all this bad news, what did it do? It gapped down yesterday. So it was in our morning, our pre-market gap analysis, and we just watch it. I don't know if it's going to go up, down, sideways. We're just watching the reaction, but it's gapping to major support, a prior low, so it has my attention. So I'm going to show you on an intraday chart on the next slide, but here's what we did. We sold so the stock's roughly at the low 300s. We went way the heck out of the money, and we sold the $275 puts just for Friday, 5 days to expiration. And then we bought the $265 puts for protection, so that's what's called a $10 wide bull put credit spread. We took in $1.03 a share. That's actually wrong. It's 5 days to expiration, not 7. So we had $25 plus, depending on where you entered it intraday, where the stock could go against us and we still make our maximum gain. The return on capital, you calculate this by the premium that you're taking in, divided by the maintenance requirement, which is the spread width of $10, less the premium received, and that's our return on capital. The break even, if we are assigned, is the short strike price, because when we sell a put, we're putting money in our pocket, and we have an obligation to buy the underlying if the put buyer wants us to buy it at that strike price on or before expiration. But you already put $1.03 in your pocket, so that's your break even. Here's how we entered it. So 15-minute chart is a good kind of stapled to watch. So bearish trend, bearish trend, bearish trend, bearish gap down. Here's pre-market consolidation. I could see it was getting its sea legs back. Then when the market opened, it filled this entire bearish gap, stalled right at resistance. So now we're watching, saying, all right, what are you going to do? Are you going to retrace bullishly, which we like, 40% or less retracement of this run from here to here? Or is it going to consolidate through time, which is actually stronger than a retracement? Why? Well, because the buyers are stepping up and paying that price for it. So there's various times you could have entered this, but a beautiful one is right here in this afternoon breakout. We actually entered earlier here in the morning. Now at 3 p.m. Eastern time, just 30 minutes, a few minutes ago, I'm watching my 15-minute chart, had a little breakout failure here, topping tail, back consolidating, started to break down just on a 15-minute chart. The daily is still fine, and remember, our risk is just till Friday at market close. But nevertheless, we closed half of it here because we're in trade management mode. Once we're in a trade, I don't care what type of trade, stock, option, commodity, currency, we're merely in trade management mode using the multiple time frames that for the type of trade that you're in, a scalp, day trade, swing trade, or position trade, and your trading plan. But we closed half at 27 cents a share right there. That's 77% of maximum gain in one day. We've booked 77% of our $3 max gain. So that's just prudent risk management. And then we're bidding 5 cents to try to make more money on the back half. And then the stop's the day's low. If you want to learn how to master these credit spreads that we do, our gold here is mastering advanced credit spreads. It's 12 detailed modules, and there's one complete module just on this subject of selling volatility on high volatility, on news, on earnings, on fear, and how to do it properly, the setup, the action, and the management in between. Hope that helped. Happy trading, and see you next time.